Hi, everyone. This is Jack Allwild with another money episode. Today, we have very special guest, Courtney May. She is Covered Calls Barbie on Twitter, and we will have a picture with her link in the description. Courtney, welcome to the show.
Thank you. Hey, everyone. I'm so excited to be here and ready to have a good conversation.
Yeah, I'm very excited. I got my matcha here with whipped cream. I'm ready to go. I always like discussing options and whoever will talk them with me. So let's get to it. But before we get to the options discussion and covered calls, Courtney, I like to ask everyone, what was your relationship with money like growing up?
Yeah, that's a great question. And I'm excited to dive into it all. But I was very intrigued and taken by the stock market at a young age. I think it was 13. When I turned 13, I got for my birthday to choose a stock that I wanted to own
Hmm.
a share of. And at the time, I also was just allowed to get a Facebook account. So I wanted to own Facebook, which is now Meta. And yeah, essentially I immediately was like, this is the best. And I remember once I earned a little bit more money working at a summer camp, I invested in Chipotle because I was like, burritos are the best. And I just from a very young age realized you can invest in companies you like and things you believe in, like burritos apparently. And from there, knew I really liked that whole system. And then wanted to study the economy more broadly, which I did in college. And then ended up in the financial services and fintech industry after that. And I feel like it all kind of was a snowball effect of realizing I really like it and really wanted to be more educated in it. And now why I made Stonk Enjoyer and Covered Calls Barbie and kind of that whole persona is to make investing education more fun because I think there's so much content out there that's so informative, but it's really intimidating. And the financial industry as a whole is very intimidating. So hopefully I'm out here trying to keep it silly and in hopes to lower that intimidation barrier to entry that comes with the stock market. Because at the end of the day, it's buying companies you believe in, like burritos, Chipotle.
Let's get into it.
Yeah.
And I guess let's keep it simple, keep it fun. So covered calls Barbie. What is a covered call and how did you get into this?
Yeah, totally. So a covered call is where you have 100 shares of a stock, which is an even lot. And what you can do is you can actually sell a contract on top of that even lot and collect a premium. And someone's on the other side of that contract buying it. And they have the right, but not the obligation to buy at a given strike price that you set when you sell the covered call. So ultimately, that premium is higher if you take on more risks. So if the strike price you're choosing is closer to the actual price of the stock, or if it's a really volatile stock. But you can also sell it further from the actual price. Like you can put the strike price really far out, make it more conservative, and you're probably going to collect a lower premium. But essentially, that's the whole idea is getting paid to just hold the stock as long as it doesn't go above a certain price.
Can we talk about some of your setups, maybe with like Chipotle or a stock that you do sell covered calls on?
Totally. So Chipotle, I've long sold, which is a bummer. Like I should have held on to it with Facebook. I just don't think that's where I long term wanted to be holding on to. Like when I got to college and used my summer job paychecks to invest, like I chose other stocks, but one of which I think in 2020 or 2021, I started investing and doing a recurring investment in AMD, a
Okay.
semiconductor company that's been really popular lately. And I recently was able to start selling covered calls on it. That's been a hard one for me, honestly. So I don't know why I started with that one, but in a similar vein, I around the same time in college when I started having my own income that I was able to invest, I was building up a even lot position in Apple. And for about 3 years now, I think I've been selling covered calls on Apple and actually cash secured puts. So both sides of the equation
Hmm.
I'm working on. But Apple's been one of my best positions to sell covered calls on because it's grown, but at a steadier rate where I haven't faced a ton of assignment risk. I have in some ways, like in 3 years, you're gonna eventually have a time when the price goes up a lot and you're forced to make a decision if you're going to close the contract, roll the contract, or what you're going to do. But Apple and AMD are my two primary positions I'm focused on right now selling covered calls, but I'd like to expand that out and continue to build on those positions, along with consolidate some smaller dollar stocks that are like $10 and under, that the premiums just aren't really worth the like stress and time of selling a covered call. So I currently probably have about 35 to 40 even lots to sell a covered call on, but I actually want to consolidate that to higher quality positions where it's somewhere around 10.
Okay. And like on AMD and Apple. So I don't really know what those prices. I know my wife actually has AMD and Apple. So it's interesting that
Yeah.
but like how far out of the money or from the current price are you selling the calls at? And what time horizon are you typically choosing?
Yeah, those are such good questions. So I'll start with Apple. I haven't been watching the prices closely because it's really hovered between like 180 and 195. And I think I currently have a covered call at 210. So
Okay.
essentially, once the stock gets to $210 or close to that, I'll be sweating a little more. But until then, if it's staying below there, then my premium is safe to me and that position is good. AMD is at 166 right now. And 2 weeks ago, I had a covered call at 165, and the position went up
Oh,
like over like 20% within a few weeks. It really caught me off guard. Because all of a sudden it was at 175 and I had this 165 covered call on it. I usually use an expiration of about a month. So like I'll go a month in the future and then I'll set that as the expiration point. I think that's pretty typical for retail covered call sellers of like my speed that's like not super high dollar, super high quantity,
mhm.
just managing one or two contracts per position. But yeah, that's kind of my two plays. And the AMD one, the 165 for 2 weeks ago on Friday, that one was brutal. I had to close it out because I wanted to maintain that position.
Yeah.
Which sometimes I'll let something get assigned and I'll sell it at that strike price, especially if it's like profitable for me and I'm willing to let it go. And then I'll either sell a cash secured put to buy the position back at a different price later. So kind of do a
Mhm.
wheel strategy is what that's called. But for AMD, I've held it for so long and I want to continue to hold it for 20 years, give or take. Like,
Mhm.
and for the indefinite future. I paid basically to close my position. And it was costly. Like it took a huge bite out of the total premium profit I've taken on AMD in general, which is really frustrating, but ultimately it's the decision I made. And so there's the side of Apple where it feels easy, and then
Mhm.
there's the times like AMD where it's frustrating and hard and you're kind of bailing yourself out of these bad decisions or like convictions that felt like good decisions that are turning out to be costly.
Mhm. So let's talk a little bit more about, okay, so like let's take Apple. So you said it's at like let's say just at 180. So to buy 100 shares, that's like 18,000. And if you're
Hmm.
selling a month out, I think you said it like 210. Like what is
Hmm.
like the premium that you're collecting each month for that?
Yeah, that's a great question. I always forget to say this at the beginning of these things, but it's never investment advice and for
Right.
entertainment
Yeah.
purposes only. But ultimately, I think you could you could say the ballpark is it's really all over the place. Like I think there's a lot more that goes into it, but part of my thesis is not overcomplicating it. So let's just call it a ballpark of like 70 to $100
Okay.
for a more conservative contract on Apple that's a month out
Okay.
for expiration.
No, it's good to compare because like a lot of like for example, like in real estate, sometimes people are shooting for like $100 a unit, and
Yeah.
they might need to pay much more to get into that property, and they might just be netting about $100. So it's kind of
Yeah.
so people can compare in their minds. Interesting. Okay, cool.
I think like a big thing try to say enough, but it's hard to like balance the excitement and like encouragement I want people to feel towards like this option strategy, cover calls and cash secured puts, and being on the writing and selling side of them. There's also a very realistic side that it takes a long time to build these even lots. And I realize that, but I hope I state that enough. And I'm not sitting here like everyone should be able to buy 100 shares of Apple right now. That's not realistic. Same with AMD. It's trading at 166. Like that's expensive. I'm like not necessarily from a valuation standpoint. That's not what I'm saying. But in terms of
Mhm.
just cash from hand into the stock market, I mean, that's a big buy-in. There's like a lot of upfront capital that goes into selling covered calls or cash secured puts. And my one thing there is it just takes time. I luckily got to start at a young age building up these positions and kind of studied finance and knew this is something I wanted to do when I got to my age. And now starting at like 22 or 23, and I'm 25 now, I was
Wow.
able to start selling covered calls. But yeah, like it took me years of building that, like putting small amounts into single positions, which isn't necessarily great if you're trying to diversify. So what I'm trying to say here is it's not the strategy for everyone. It takes time to build. And it takes a lot of upfront capital. So
Mhm.
keeping all of that in mind is very important before you just like, I want to collect $70 every month from holding
Mhm.
Apple. Like it's not that simple, unfortunately.
So I think I'd like to maybe dive in a little bit because you said AMD you really like long term. So
Yeah,
can we discuss like the pros and cons? Like if you really wanted it long term, maybe just discuss whether to just hold it and not sell the calls versus so like the premiums that you're collecting, are you buying more AMD? Like when would this be good versus when would this be bad?
totally. And this is a conversation I have with like my boyfriend all the time
Uh-huh.
because I'm still young and learning. And it's actually funny because tomorrow's Stonk Enjoyer piece that I write, and they come out every Wednesday, is about assignment risk. And kind of touching on that whole thing is, should I be writing covered calls on a long-term allocation that I'm bullish on? I don't know. I'm doing it right now and I'm working on it and I'm building out a solid thesis. But ultimately, I'm trying to collect premiums that are super conservative on these positions I'm holding long term. Now, that just got me in trouble about a few weeks ago with AMD. I had to buy myself out of this position. And basically I'm at like a net zero, I have not like I've basically canceled out all of the gains on premiums I've ever made. But ultimately, it was to protect a long-term position that I want to hold because I have a pretty big semiconductor allocation in my portfolio. So just like NVIDIA, AVGO, like Intel, a lot of the big semiconductor names and some smaller ones, I hold those. But when it comes to selling covered calls on them, I think you just have to be so conservative and then also prepared to buy yourself out of those contracts. Um, it's again something I'm working on a lot, and I think a lot of people would say don't do it. But I'm trying to figure out a way to do it successfully where I'm not capping my gains all the time, because that's a huge downside of selling covered calls is you
Mhm.
cap your gains. Like, oh, you could have made a lot more on that position, but instead you sold at a strike price that you decided on a month ago to make $60, and now here you are, like could have made 200 more dollars on the position, and you're selling when you didn't even want to sell, and you're getting taxed on a gain you weren't even ready to take. So I understand all those downsides, but I'm trying to build a portfolio where my covered calls are so conservative that they're not affected by like super big price jumps. But the premiums are still worth it.
Mhm.
The fine
Okay.
balance. And I'm
Interesting.
working on it now.
Yeah. Worst case scenario for you is you're only, I mean, well, not worst case. I guess the stock could go very far down, but
True.
if you do get assigned, I mean, it's like, okay, I'm only making this instead of like this higher amount.
Totally. And the thing is
So,
too, is like covered calls change over the years. Like in 2022, man, in a lot of 2023, it was a great time to sell covered calls, especially like 2022 though, when stocks were just going down, and like we were kind of we went through like a over 700-day period where the S&P 500 didn't hit an all-time high and things were slower. It was so easy, and you could be way more aggressive selling covered calls. Now, like tides have turned a little bit, and I feel like in the last 6 months, I've had to really buckle down and kind of refine my strategy because, yeah, when you're in a more of a bear market where prices are not hitting all-time highs, covered calls are awesome. They're basically like a hedge. And then now stocks are hitting highs. Like covered calls are tricky. They cap your gains, and you've got to be extremely conservative and ready to be extremely conservative and not let yourself get greedy with premiums.
But now, besides the covered calls, are you doing anything else with options?
Yeah, so I used to buy options more, which is not great. I like love to hear people that have really high convictions and like buy calls on AMD, or like my best one was, I can't even remember like the medical company, and I bought a put. So I was making a bet that the stock would go down. And then because news like that morning publicly came out, oh hey, there's a huge security breach at whatever company it
Oh,
was. I don't even remember at this point. And so I was like, oh, this is perfect. My put's going to go up. The price of this contract should definitely go up. And I checked the options chain, and the price had gone down. And it was like 1 + 1 equaled zebra. Like the math did not make sense there. So given that situation, I was like, I don't need to be I don't need to be full on just gambling essentially,
hmm.
which I don't know if that's a super hot take, but it is kind of gambling. Nothing against that. I used to do it. I occasionally like to bet on an NBA game too,
Uh-huh.
because I think I know the result. Oh, the Thunder are so good this season, like gonna buy a call on the Thunder and say that they're gonna win this game by X amount of points. Like it's great. I think it's hard long-term consistent strategy. So I stick with writing covered calls or cash secured puts. Covered calls is my primary strategy, but I will have a cash secured put or two in my portfolio at a given time.
Okay. And can we just break down what a cash secured put is? That's basically where you have the cash for a specific strike price that you pick. So
Yeah,
if the strike is $18, you would have to hold 100 shares worth at $18. So $1,800 you'd have to have in your account.
you're
And
close. You're
uh-huh,
like right
okay.
there. It's like you don't actually have to hold the shares, you just have to have the cash as
Cash.
collateral. $1,800 on hand to be able
Hmm.
to buy 100 shares at a given strike price if it dropped to that point. So you're like,
Hmm.
it's basically a whole inverse of the covered call, but very similar in kind of nature and
Hmm.
ideology.
Yeah, because I've heard a lot of people, and you mentioned it a little bit, like the wheel strategy, where you'll do a cash secured put to get into the position and then sell a covered call once you have it. Instead of people like putting in these limit orders, you might as well get paid for entering the position.
Totally. That's exactly the mentality I take in my Roth IRA. For TSM, I do a wheel strategy essentially where if I do get assigned on a covered call and I sell, then I just sell a cash secured put and buy it back and kind of
Mhm.
flow in that wheel state. Now, I'll let you know how it goes in like 10 years because I'm hoping to do it for a while, but it's been great. Like it's the stock, like I've made a profit, and I've kind of continued to build up these smaller, just monthly like premiums, along with when I've sold when I've been sold a sign on the covered call, it's always been at a gain.
Mhm.
So it's kind of like I feel like it's kind of a bad example because I don't think it's always going to go that well, but it's the one stock that I'm choosing to focus on right now with the wheel strategy. And then I recently came into some like money from closing out some smaller positions that were just like when I was younger and kind of doing super stuff with my portfolio and wanted riskier things. And I pulled together enough money to where I've sold a cash secured put on Apple, and with Apple, I'm just hoping to like build up that position. And I never want to sell, right? Like sell assigned. So I'm hoping to sell with like conservative enough premiums to where I never get in the position where I need to do the wheel strategy. But that's another one I will sell cash secured puts on right now that I've probably been doing for about 4 months in hopes to actually buy the security sooner rather than later.
Cool. I did see on your Twitter you also had that you worked at Robinhood, or
Yeah.
maybe just participated in Robinhood. But can you tell us? And were you there like during the GameStop, all that fiasco that was going on a couple of years ago?
Yes, yes, and yes. Yeah, like I need to clarify in my portfolio that yeah, I'm an ex Robinhood employee, not just a user. I'm
Okay.
still a user of the app. It's like
Hmm.
such a good user experience. Like you really can't get that UI UX anywhere else. But I was at Robinhood for close to 2 years. And yeah, I was there January 28th. I think it was 2021 when all the GameStop excitement was happening. I will say it was my second day on the job. So it
Wow.
wasn't like, and I remember I was actually like, this was such weird timing. I was at the dentist and my phone is blowing up and I'm like getting a cavity filled. And so I'm like filled with the remorse. Like, how could I get a cavity? Probably because I never go to the dentist. So yeah, I'm not a good example when it comes to dental work. But I look up at the news, like above me at the dentist, and I see like Robinhood under duress for like position closing only, GameStop, and I'm like, what? Like I'm at the dentist and I'm on the brokerage desk. I no longer have an active Series 7, but I used to, and
Hmm.
I when I first started at Robinhood, it was kind of a free for all. Like there wasn't as much delegation and scope that was what you were gonna actually do at your job. So I was doing a lot and I was working a lot with like the GameStop situation, but I did my best with what I could. And it was like a crazy Six Sigma situation that we'd never seen before in the market. I think retail investors are better for it, but it definitely showed the dire need for investor education because like putting your whole savings in one stock is never the best idea in when it comes to investing strategy. And like because the stock market, like sometimes exchanges halt or individual positions are halted. And that's just the cold hard truth that I think a lot of people learned. And then I don't really have like a strong opinion on what Robinhood did or didn't do because I was not very involved in I was not involved at all
Hmm.
in any decision making, but ultimately it was a wild time and I learned a lot through those months of chaos.
Cool. So you touched on like comes back to financial education. Are there any books or resources that you've used along the way that you really felt helped you solidify some of these concepts?
Yeah, that's hard because I feel like my main financial education came from getting my Series 7, which not
Ah,
everyone is
okay.
going to get a Series 7. So I've been asked that before and I need to think of a better answer. So
Okay.
sorry to
For
everyone
people
that I
that
don't.
don't know, for people that don't know what Series 7 is, can you kind of explain that?
Yeah, it's your brokerage license. So it's a license to like help clients buy and sell stocks. And you have to know everything from stocks to bonds to options. It's very intensive. And it's like a challenging exam. But ultimately, FINRA or the Financial Industry Regulatory Authority. I'm so groggy this morning. But they make brokers take this before those brokers are gonna go help traders, retail or institutional, make a trade in their brokerage account.
Gotcha. Okay.
Yeah. But one of the reasons I did start Stonk Enjoyer was because I wanted to write about these concepts and make a really fun and short and digestible resource for people. I don't think Stonk Enjoyer is where you should be getting all of your news, but I do think it's a good place to go and read about portfolio strategy or how to react to like broader macro trends in a way that's like not super technical. So like I don't recommend it. Like I use the Morning Brew or Robinhood Snacks or Yahoo Finance, like a lot of the
Mhm.
basic or Bloomberg, like for my financial news and a lot of my like deeper dives into certain things. But then I try to write about that stuff once a week in very like basic ways so people can be like, oh, here's what a covered call looks like in this really high interest rate environment. Because like
Mhm.
I'm not going to go crazy and like talk about super in-depth macro theory of like what all the Fed can do to raise or lower interest rates, but I'll say, hey, interest rates are high right now. Here's what that means for a portfolio.
Cool. Awesome.
Yeah.
Well, as we are winding down, I do like to ask everyone, what's the best and worst personal finance advice you've either heard or received?
Good question. Probably best is to diversify. It just literally like learning about diversification is such a game changer. And even if that just means like you're buying SPY and investing in the S&P 500, like diversification is key to not putting yourself in a really bad financial situation, but still exposing yourself to the power of compounding. Then, like, I guess the flip side, the worst investment advice I've ever been given, it would probably be like people going all in or like that, like hold the line, like all in on one stock. Like, it's
The
almost hard
diamond
to watch
hands?
sometimes. Yeah, diamond hands. Like, in some ways, I respect the loyalty, but being very attentive to how much risk you can handle and making sure you're not exposing yourself to too much risk. Because ultimately, you need to be able to say the money I have in the stock market can go to zero and I will be able to continue to live my life safely and like continue and to protect my well-being. That's so important. So like if you're going all in on one stock, there poses a lot of risk there.
Mhm. Well, Courtney, I've had fun talking to you. Why don't you tell the listeners where they can go get your newsletter, where they can go reach you?
Yeah, thank you so much for having me, Jack. This has been fun. Sorry, I feel like I've been talking so much, but ultimately I would love for anyone to follow Covered Calls Barbie. That's my X account or Twitter. And then Stonk Enjoyer is my newsletter. It comes out every Wednesday for free. And I also include a meme, so hopefully it makes you smile or laugh. Um, but yeah, those are the two places to find it. And the link to Stonk Enjoyer is in my bio on X.
Okay. We will be sure to link those. Thanks so much, Courtney.
Yeah, thank you so much for having me.
It's been fun.